Okay, good day. So our topic for today is closing entry. So what is a closing entry? Closing entry because normally we do the journalized entry, and once we already finish all the financial statements, we also do our closing entry. So we close all the entries. So let's take our starting journey to know what is closing entry. So what is closing entry? Closing entry is a journal entry that is made at the end of accounting period to transfer balances from a temporary account to a permanent account. So normally, the temporary account is also called as the nominal account or the income statement account. Remember, on our previous video presentation, income statement, we state that temporary account are closed to zero every end of the accounting period so that we would know which year is more profitable for the business and which is a losing year for the business. So that's why we usually close all the temporary account back to zero every account end of accounting period. Next, we also have the permanent account. The permanent account are also known as the real account or the balance sheet account. It's called real account because this account are the real account, literally, because it is the account that accumulate over the start of the business up to the publication or until the business lasts. So it never revert back to zero. That's why these are the balance sheet account. So remember, we have permanent or real account, temporary or nominal account. So what are closing entries? So we do closing entries for the temporary account. Since we said that temporary account is also the income statement account, it includes our revenue and expenses and the dividend payment. However, take note that the owner's drawing, despite it is temporary account, it is not close to income summary account because this is a contra equity account. Okay, and then we also have the income summary account. We would discuss the income summary account later. Then we have the permanent or the real account. These are the balance sheet account. So what are the element of balance sheet? We said before, these are asset, liabilities, and equity. Okay, so income statement account for temporary and balance sheet account for our permanent accounts. So the process of preparing closing entry. Number one, we close all the revenue account to income summary accounts. So take note, income summary account is a temporary account or an umbrella account for the income statement. So all the accounts that are closed at the end of the period are closed to the income summary account. So the first one that we would close is the revenue account. So the revenue account is include for the services, the service revenue, the rental revenue, and then for our merchandising, these are sales and sales return and allowances as well to our manufacturing industry. So we also have the expenses account are also close to the income summary account. So we would determine which one has the higher. So if revenue is higher, then income summary account would have a profit. If expenses is higher, then therefore the entity is losing. Okay, so what are the expenses account? So these are from our income statement video. We have the cost of goods sold, which we discuss each one for each industry. Then the selling and administrative expense, the finance cost, the distribution, and other expenses that are used to earn money for the business. Then we also close the income summary account to equity account. So what are the equity? Capital account or the for the partnership and sole proprietor. But for corporation, it is our retained earnings. Next, next we close the withdrawal account to equity account because previously we said that withdrawals are also contra equity account because these are money of the owner that he will be using for his personal activities. So here is, do you still remember this? So I put the both the unadjusted, the income statement and the balance sheet so that you would know where the income statement and the balance sheet comes from our adjusted trial balance. And since we would close all the income statement account to balance sheet account, so that's why we get this particular table. So we get the income statement account for our first closing. So first, our first step is to close the revenue account. And in here, we only have one revenue account, which is 175,000. So we debit service revenue 175,000 and credit income summary account 175,000. So if we go for our T account, you would see that the service revenue is now 0 because both debit and credit has an equal balance of 75,000. Okay? So we have now sales revenue. Okay? So we have now, we already finished with the revenue account. So we close now the expenses account. So we have utilities expense debit 34,000, salaries expense 50,000, rent expense 30,000, supplies expense 33,000, depreciation expense 6,416.67, all on its debit side. So since it's a debit side, we had to close it putting on the credit side. So we debit income summary account at 123,416.67. And then we debit all the expenses account to close all the expenses account. So let's take, for example, the utilities expense to show you. So we have utilities expense, debit balance of 34,000, and we do our closing entry. We credit utilities expense at 34,000. And it's just go the same to each and every expenses. Okay? Next, we have debit service revenue 175,000, income summary account 175,000 to summarize, and then income summary account 123,416.67 debit balance. So if we do the T account, our income summary account has a net balance of 51,583.33, or also known as our net income. Okay? So next, we now close our income summary account. So we close our income summary account. We debit income summary account with a balance of 51,583.33. We credit lay withdrawals 10,000. And then lay capital 41,583.33. So in here, we already do the compound entry. But you could still have the option to put it on a single entry like debit income summary account 51,583.33 and then credit lay capital 51,583.33 and then debit capital 10,000 and then credit withdrawal. But for easier purposes, I just do the compound entry. Okay? So let's do now the T account to show you. So remember, our income summary has a credit balance at first at 75,000 for closing the revenue, which is our first step. And then our second step to close all the expenses account. So we now have a debit balance of 123,416.67. Then after that, we close the income summary account to our capital, which is 51,583.33. So we already close all the temporary account. Next, we also close the withdrawal. Since the withdrawal has a debit balance of 10,000, we credit it to our capital account 10,000. Now, the capital balance has a beginning balance of 100,000, and from our closing entry, it add up 41,583.33. So, we now prepare our balance sheet account. So, we have now cash, 61,000. Accounts receivable, 75,000. Supplies, 2,000. Computer, 25,000. Less its accumulated depreciation, which is our contra asset account. Credits, 6,416.67. Salaries, 10,000. Revenue or unearned revenue, 5,000. And then lay equity, 141,583.33. So, this is now for our next accounting cycle. We only have all the real account or the balance sheet account or our permanent account, and no more temporary or income statement account, so that we would determine each year which business become more profitable than the other year. Okay? Hi guys, so if you like this video, please help me reach out more people by hitting the subscribe and the like button below. God bless you all. If you have question, just comment below. I'll get back to you as soon as I can. Bye!